All right, joining us right now for insights on what the new jobs data could mean for the Fed and its rate decisions this year is Roger Ferguson, former Fed vice chairman. He's also a CNBC contributor. And Roger, tell me what the Fed thinks about this number.
I think the Fed thinks about it exactly how you've been talking about it, which is good news. The labor market that they had feared was softening appears not to be. Challenging news, the anecdote, the thought that inflation is going to continue to come down now is very much questioned. And I think, as I said the last time we were on, the probability of their getting off 2 cuts next year, this year, seems to be very, very remote at this stage. So good news is good news, and good news is challenging news.
Okay. What about the news that the 10-year is now sitting at almost 4.8%?
Look, I think the 10-year and the bond market in general is doing what it's supposed to do, which is saying in this market where we are also expecting, continued private sector demand for credit, continued government demand for credit both in the U.S. and around the world, the way that gets equilibrated is higher interest rates. And I think that's just a reflection of the market doing what it is supposed to do, which is telling, a supply and demand story. You're going to need higher rates to bring savings into these markets, and that's exactly what we're getting. So I don't think there's a way to manage that. I think that's the outcome of supply and demand stories and the way the market sees the future.
One of our guests, Allison, was just mentioning that this could be the new reality. Is this the new normal? Higher interest rates, higher levels, the 30 years almost at 5%.
Look, I think it goes back to a point that I think Joe and I talked about a couple of shows ago, which is the elusive so-called R star, and is a so-called neutral rate higher because we have new demands for capital, because we have new technologies that might lead to greater productivity. And so perhaps we should get used to this, not because it's a bad thing, but because it shows that there is many, many productive uses of capital. And hopefully that plays through into productivity increases, which allow for companies to be more productive. So net, I think this probably is the new normal, and we should get used to the fact that we're not going to see a dramatic movement down in long rates anytime soon.
Should we also think that a new reality is inflation running above trend?
I think so. One of the things I've said, I think, a few times here is I've been quite concerned that inflation actually is as sticky as it appears to be. Some of what's driving that is supply and demand imbalances in housing, for example, and it's really hard to fix that. Now we have an administration coming in that seems to be leaning more towards things that appear to be likely to be inflationary. And so, the 2% target may prove to be elusive, or to put it another way, to get to the 2% target may require the Fed to really crunch the economy. And that is a tough trade-off for them to deal with at this stage, I believe.
Okay. Roger, you always speak so plainly. That's a lot of things that have been circulating that they wouldn't necessarily expect to hear a former Fed official saying outright like this. But you are always with us to interpret this stuff, and we really appreciate it.